Hello and welcome to today's Your Daily Five. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and I'm happy to join you on this Thursday, November 17th. Before we get started, I got a few interesting charts I want to show you today, but I do want to point out that later today, starting at 5:30 Eastern, we will have our portfolio draft event. That's where we put our 10 equal weighted stocks into each of our portfolios, and then we attempt to outperform the S&P 500 with those stocks for the next 3 months. Again, that'll start later today at 5:30. If you want to join, that is a member-only event. If you go over to earningsbeats.com and then simply click on the Start Your No-Cost Trial, you can join us. We do also have our fall special going. This is our best deal of the year. We started this last weekend, and it'll be running probably for about another 10 days or so. But if you try our service and you like it, you'll have an opportunity to extend your membership using the best deal we have all year. So it's a great time to give us a shot. Those portfolios, by the way, if you scroll down, we actually have a link here where you can see our historical performance. But if you notice the model portfolio since inception, up 116.7%. The S&P 500 over the same time frame, up 47%. So we've outperformed by quite a bit. That's since November 19th, 2018. Our aggressive portfolio, 95% versus 38%. Of course, that started, the inception date was a little different. That started back in 2019 during May. Income, same thing. We actually have underperformed slightly on the income, 22% versus 38%, which actually is what I would expect, given that most of what we have done, or most of the period that we've been in, has favored the growth stocks, and income stocks are going to be more value oriented. So I would expect them to underperform. This quarter, you can see we've actually outperformed 2 of the 3 portfolios versus the S&P. This is as of yesterday's close. The aggressive, which is slightly below, maybe we can win all 3. This quarter goes through the end of the day tomorrow on Friday. So still got a chance maybe to make up that ground on the aggressive and finish with 3 portfolios that beat the S&P 500. We also do a model ETF portfolio, and you can see the percentages there slightly higher this quarter. Now, if you notice this quarter, the percentages are different. We have different quarters for our model ETF. We run that right now. This is October 19th through January 19th. The current stock portfolio, is August 19th through November 19th. So we're looking at different times. That's why this quarter percentage is different. Anyhow, if you want to learn more about that, it would be great to check us out and sign up just for a free 30-day trial. All right, let's talk about the 5 charts that I want to show you today. The first one, the 10-year Treasury yield. This has had a major impact. The 10-year Treasury yield rising throughout 2022 has had a major impact, not only in leading overall stocks lower, but if you look at the relationship between growth and value, and I just used the QQQ versus the SPDR, which is, these are 2 ETFs. One tracks the NASDAQ 100, the other tracks the S&P 500. NASDAQ 100 tends to be more growth oriented, more companies that look for capital appreciation versus companies that pay dividends. The S&P 500 is a little bit more diversified, a little bit more dividend oriented, certainly more value oriented. And as you look at this ratio, it's been going down, and it effectively has been the mirror image of this 10-year Treasury yield as it's been going up. I point this out because I believe rates are starting to come back down. We'll see what happens over the course of the next few weeks leading up to the next Fed meeting, but it certainly looks like we're beginning to trend below that now declining 20-day moving average. We've got the 10-year Treasury yield at yesterday's close down at 3.69%. I know this morning it is up a little bit, but still well below that 20-day moving average. We'll see whether or not that 20-day holds to the upside. But as we start to roll back over on interest rates, you can see that the QQQ versus the SPDR are starting to turn back up again. This is very noteworthy because it's going to depend on what rates are doing as to where you want your money as we wrap up 2022 and move into 2023. I believe rates are going to trend lower. And as a result, I think any pullbacks in the QQQ become viable, because I believe the QQQ going forward is going to outperform the spider, at least based on the information that we have at this time. The other thing that the 10-year Treasury yield does, I'm pointing out the QQQ versus the spider, but if we look at growth versus value across the different asset classes, here we've got the top chart here is the large cap growth versus large cap value. Then we have mid cap growth versus mid cap value, and then small cap growth versus small cap value. And again, down here at the bottom is that 10-year Treasury yield. And you can see as we've been going up, so as the growth stocks have been going lower and lower, and you can see the large cap growth versus large cap value actually went below the May low after it had been trying to print that as a bottom. The mid cap and small cap growth versus value ratios, however, are still holding above the May lows. So that's unusual with the market going down to new lows and with talk of recession ahead. It's interesting that we're seeing both mid caps and small cap growth versus value indexes, that those ratios continuing to hold the May lows. But now with rates beginning to move lower, if this continues, and again, that's a big if, I believe it's going to, but if it continues and we do not go back up above that double top around 425, 430, then I suspect you're going to see continuing rally in growth stocks into year end and into 2023. Market looks ahead. Market doesn't necessarily look at what's happening right now, and I'll show you that in just a couple of minutes with a different chart I have. So we got to pay attention to what the signals are that the market's sending us. And I think at least with the mid cap growth versus value and small cap growth versus value, it's sending us a signal that we're either at the peak of interest rates, or we're probably getting very close. Next up, I wanted to show you sentiment. I think sentiment is a huge indicator in the market, spotting tops and bottoms. This is the equity only put call ratio here on the top, but it's the 253-day moving average. Now, as you reach these new lows, what this is telling us is that the market is getting incredibly bullish. When this ratio is going down, it's telling us more calls are being bought versus puts. And when it's rising, it's telling us that the market's getting more fearful, more puts are being bought. And we reach a crescendo of fear, and then we start rolling back over again. The interesting part is I want you to look at these tops and bottoms on this 253-day moving average, because when we bottom, that means we've gotten to an extreme level of bullishness. And you've got to be really careful in the market when that happens. So down here on the bottom, you can see right when that extreme level of bullishness comes in, it's in 2006. Now, we did end up going a little bit higher, but by the time we finished moving back up and resetting sentiment at a much more bearish level, we had fallen 51% from where we were when we started the period. The next time we reached a bottom here, again, what we're looking at is too much bullishness in the market. And as a result, over the next year and a quarter or so, market goes almost nowhere, ups and downs, but almost nowhere. 2014 through 2016, this 2-year period, bottomed, too much bullishness. What does the market do over those next 2 years? While the sentiment's resetting, it does nothing. Then in 2018, we get to a time when we're too bullish. Remember, we had the trade war at the end of 2018. That started to create the fear. The fear went up for the next year or so with the trade war, and we had a lot of choppiness. But really, throughout this period, market went nowhere. And then to begin 2022, I talked about this at our Market Vision 2022 event. And by the way, our Market Vision 2023 event is coming up on Saturday, January 7th. So mark your calendar. This will be the 4th year that we've done these prognostications, and they have been right on the money every year so far. I was calling for a bear market, cyclical bear market that would last 6 to 9 months. Actually, I think at the beginning I may have said 3 to 6 months. I think it was after we were into it for a couple of months. I stretched it out, thought it could go as long as 9 months. It actually went 10 months. It went to October low before turning back up again. But look at how complacent the market had become. I mean, the 253-day moving average of the put call ratio was down way below anything we'd ever seen. The market was so bullish, so complacent. And that was my number one reason for being so bearish to start 2022. And look what has happened from there to here so far. We haven't turned. I think we're going to turn. We haven't turned yet, but right now we're down 15.7% from where we were at the bottom here to where we are now. So when we reach these bottoms and start turning back up, you want to be very, very careful in the market. The opposite holds true, though, too. When you get to this extreme bearish level and you begin to roll over here, roll over here, roll over here, roll over, I want you to take a look at these 4 green vertical lines and what green dotted vertical lines, and see what happened after, until you hit the red dotted line. Look at what the market does. Straight up, straight up, straight up. And, well, choppy, but eventually straight up. When we start this rollover, you want to be aware. Market, the sentiment is being reset. Just like I talked about at the beginning of the year, we are resetting sentiment. And when this rolls over, and I think it's going to happen within the next month or two, you're going to want to make sure that you are long the market. The reason I think it's going to roll over, this is chart 3.1 here. But here's the daily put call ratio. And if you look back, November and December is when we started seeing rises in the put call. And if we're looking at a 253-day moving average, as we move forward, these readings are going to drop off. And if the market becomes more bullish and we move down to this level, we're going to see that 253-day moving average top off and roll over, just like these others did. And when that happens, you want to be long the market. Fourth chart here is going to be home construction. I just want to point out, we have been having months of horrible news in home construction, and yet the Dow Jones U.S. Home Construction Index relative to the S&P 500 bottomed back in April. It's been moving up. We are actually trying to move to about an 8-month high. A break above 1,300 would be extremely bullish. This is where the market is looking ahead, and this is why I believe rates are peaking or are near a peak. Because the stock market looks ahead, Wall Street is moving into home building stocks. Why in the heck would you do that if you think rates, which recently mortgage rates were up over 7%, if you think they're going to keep going higher, why would you invest in home building stocks? You wouldn't, which is why I think rates come down. Last chart I want to show you is just this long-term chart on IBM. I mean, what technician doesn't like a breakout? Well, look at this. This is 10 years of consolidation. IBM just breaking out above all of this mess right here at about the 140 level. We're now at 144. Like to see, continuation, get that follow through and confirmation. But I think IBM is one to keep on your radar. All right, that is it for me. It was certainly a pleasure joining you today on your Daily 5. Please remember to go to earningsbeats.com. Which I pointed out. You can sign up for our free Earnings Beats Digest newsletter, and you also can start a free 30-day trial to our service and join me at 5:30 this afternoon for our latest stock portfolio draft. Have a great day, everybody. Happy trading.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.